All right, so today is Wednesday, March 5th. This is the 12:30 p.m. section. It's being recorded. Um, so as we get started today, I mentioned on Monday to the other section, if you'll watch the video, but just to cover for everybody's benefit, a couple of changes that we're making to the syllabus. The first one involves your group project. So basically, the original goal when I wrote the syllabus was that you would do your group project presentations the Monday after spring break when you return. And I was just thinking that's not ideal for anybody. So we're going to actually do the second group project presentations on historical analysis, CFIs and ROIC trees next Wednesday, 1 week from today. So that way you guys are done before spring break. Don't have to think about anything during spring break until you come back. And then that Monday that we come back from spring break, we will start the third section of the class, which will be valuation, which will involve, again, the valuation modeling. So come prepared with Excel, ready to go, and we'll do that. You'll also likely need to try and be in the lab as we do some of these things in the valuation side. So hopefully by that time, I have the physical strength to basically do all 4 sections that day simultaneously. That's what I'm trying to work towards. Anyhow, so that's the current plan relative to logistics. In addition, I'll go ahead and share my screen here. The Bloomberg Trading Challenge ends next Wednesday. And so very important. Let me get the Bloomberg here. Is it not? So it'll end next Wednesday, same day as your presentation day at 5 p.m. So very important, you do not want to liquidate your portfolios. So the same rules still apply in terms of the trading challenge. You should stay, under 300,000 in cash. And so just treat it as if there's another day. At the end of that day, I'll just take screenshots and then that will be the ranking. And so again, as we're getting close to the end, I'll do another check-in here on the trading challenge. So going by section, I'll start with yours, which is your section 201. So here's where you guys stand right now. And you're going to be judged on portfolio value, right? So fortunately, nobody's got a positive portfolio value. The market's been pretty brutal. But again, stay under 300,000 in cash at all times. Everybody needs at least 10 longs. You meet the requirement. So basically, if the trading challenge were to end right now, first place, 5 points, 4, 4, 3, 2, 1. That would be the point distribution as of right now. But you can see it's fairly close amongst the teams kind of in the middle of the packs. That might switch a little bit. But regardless, you need to keep trading through next Wednesday evening. And then what we'll do is, I'm just going to pull up the other sections so they can see this in the video. This is where they stand. And again, I don't count, but basically same concept. The point distribution, if it ended today, 5, 4, 4, 3, 2, 1. And section 301. 5, 4, 4, 3, 2, 1. If we were to end today, and section 401. And again, 5, 4, 4, 3, 2, 1. Notice that across 24 teams, no one's making money. It's been a brutal market, particularly the last week, and you got to work your way through it. Just do remember, you can go short on things, and there are ETFs which go down as opposed to up, so you can use those as well in your portfolio. Any questions about the trading challenge? All right, seeing no questions. So what'll happen is trading challenge goes through next Wednesday. I'll reset it the Monday you get back from spring break. So again, you don't have to worry about trading over spring break. So again, then the second half of the semester will start. You'll start with $1 million. All your trades have been wiped out. And then it's just like we're starting from scratch. Everybody starts with $1 million, needs at least 10 long. Second half of the semester, I'll give you a few days to get out of cash, and then we'll continue a second sprint. Okay. All right. So based on that, a couple other syllabus adjustments to Elms. So another syllabus adjustment that I made was that because we moved the team project to next Wednesday, which I believe is March was that 12th, then there's still going to be a homework due on Monday, another practice of the historical analysis. And also over here, where you have your peer reviews for historicals, I switched that to the Friday before spring break at 5 p.m. So note that change in deadline as well. So Wednesday, you do the presentations, submit your peer reviews by Friday. For the peer reviews, you can use the same template you used to submit the first set of peer reviews. I would just recommend, add another column. And so you have your EIC column, and then you have your historical column with all the team members on it, and then submit that. That's the easiest way to do it. And just keep that handy for the other three peer reviews that you'll need to do. All right, so those are some of the adjustments to the schedule here. Again, questions about anything? All right, so just talking about that presentation. So next Wednesday, here's what we currently have lined up. I've reached out to your TAs, and your TAs are going to physically be there in College Park in 3505 listening to those presentations. So the presentations will not be virtual. The presentations will be in person, similar to what we originally planned, 10 minutes per team. All 6 teams will go in that room, 3505 next Wednesday in each of the sections. Okay, so nothing will be submitted online other than before the group project is due. You need to submit your PowerPoint, which has your your trees and your CFIs, and any accompanying notes need to be in there. Very important that when you're doing your 10 minutes means 10 minutes. We only have a little over an hour in the class time. We got to get through 6 teams, 10 minutes each. So got to keep everybody moving. Again, when you're making your presentations, if you're not using numbers, you're going to lose points. That was true throughout the semester and everything. So you got to refer to numbers when you do that. You got to have the data to support the numbers. So if you talk about things without data, you're not going to get credit for that. You got to make sure you cover all parts of the tree, all parts of the CFI, including the intermediate years and the historical context on some big changes, which we'll give examples of as we go through today. So that's going to be your group projects next Wednesday. And again, even though I will be there hopefully virtually, but at least the TAs will be there physically, when teams are presenting, you will be respectful, pay attention, no phones, no computers, etc. If the TAs notice in the room that you are, then they will be instructed to take 4 points off of your team's presentation and remove you from the room, and all of you will be taking the final exam. So I hope it's not an issue, but regardless, the TAs will be enforcing that because they're going to be the ones primarily in the room listening to those presentations. Yes, Brian?
Do we do the presentation at the time of our sections?
Yes. Yeah, so it's just like a normal class. So you're going to be there at 12:30 next Wednesday.
Okay, thank you.
Yeah. And if anybody's watching this video in a different section, whatever section you go, that's when you go to present. So if you're in the 11 a.m. section, show up at 11. Just normally, you're going to present. The only difference is you might be there virtually and your TA will be there physically. And because of that, the TA is the primary grader because they're actually in the room. I'll be listening as best I can, but I want them to kind of, take the lead, and I'll just kind of make some comments at the end to the TAs. Other questions? Yeah, Colleen?
When is the midterm gonna be?
Great question. What I did on Monday, and I'll remind everybody, not just your section, but all sections, is because we went virtual, the original goal was to have the midterm in class next Wednesday. So what I've changed is we're going to do the presentations rather than the midterm in class next Wednesday. And the midterm you'll take online through Elms. So you'll actually go to the assignment here. And under exams, there's a midterm exam, right? That shows not available, but it will be available starting Wednesday, March 12th at 6 a.m. And you have to complete it between that time and March 14th at 11:30 p.m. So I'm basically giving you Wednesday to Friday a range to take the exam. It is a 90-minute exam at maximum. So basically, do not click on that link when it becomes available until you're ready to start the exam, because it will start down the timer. And after 90 minutes, you won't be able to submit anything. So you must submit within 90 minutes of starting anytime during that 2-day period. For those of you listening that have an ADS accommodation, you're wondering, like, how does that affect you? You're going to take the same exam as everybody else. The only difference is your ADS accommodation will be in there, so you can take that based on your time, the ADS accommodation. Again, same time over those 2 days, all of it's being taken at Elms. Okay. It is a 10-question multiple choice exam. Each question worth 1 point, 10 questions. Every question will have none of the above answers in them. It is open book. It is open notes. You just cannot collaborate or use any extra materials beyond what's in this class. But as I told the last class when I mentioned this, like, I don't believe in memorization. My questions are not, what's the fourth word on page 306 of the text? You know, whatever. You read the text, you didn't, don't care. Do you understand the concepts? So the 10 questions are about the concepts. And if you got to look it up in your notes, I'd rather you get it right and look it up in the notes than try and do it all from memory or have some kind of stupid 2 pages that you can write on. So again, when people often ask me, like, how do you study for the midterm? I will let you know it does not require Bloomberg and it does not require Excel. The exam is just basically all qualitative questions. And there'll be 10 of them testing you on the theory of the class to date. Anything in the book is fair game based on the readings we've had so far. Anything in the lecture notes is fair game. Anything we've talked about in any class, including the video classes, is fair game. Although I'll tell you, I'm probably not going to ask questions that weren't at least mentioned at some point during the class. Questions? Just to double check, the presentation will be presented at 5 p.m., not during class time. No. Your presentations are during the class time that you are registered for next week. So again, everyone that's on the call right now in this section, you are presenting between 12:30 and 2 p.m. next Wednesday. Okay, so all 201s need to be there in the room during that time. And again, we're not taking attendance this year. So if you don't show up, we can't enforce that too much, other than we're expecting your team to enforce it. Because if you're not fairly participating in the peer reviews, we expect your team members to basically deduct you for not showing up. Okay, so I'm not going to enforce attendance. I'm going to enforce the peer reviews, and your team members can decide that if you want to, like, go do something else and they show up and you were disrespectful to them, I hope it shows up in the peer reviews, because your grade will be reduced. So that's how we're going to enforce it. What we're going to enforce is respect. You will respect the people that are presenting. And if you're capable of doing that, then my recommendation, don't show up. It'd be much worse for your team if you do than if you don't. Will you need a terminal for the exam? No, you do not. You do not need a terminal for the exam. You do not need Excel for the exam. It will all be qualitative questions. But the exam will be on Elms. So again, you'll come here, click on the midterm, it'll be available. You can kind of see on my screen, March 12th, 6 a.m. Anytime after that, you got 2 days to click on it and take it. within 90 minutes or within your ADS accommodation. Do we have a practice exam? No, I do not. Other questions? And remember, TAs continue to have office hours. As a matter of fact, I thought I saw Ashley somewhere in the Zoom call. So take advantage of that as well. And they took the exam last year. They can probably give you some additional pointers. But again, open book, open notes, okay. Just no collaboration. It's an exam. Any other questions about this or anything else before we dive into today's concepts?
I did have a question about presentations next week. Would we still be enforcing the iPhone and technology rule?
Absolutely.
Thank you.
Yes. And I would expect as the TA that, as I said, I may not be there, I might be looming on a Zoom or something, but I still expect that whoever's presenting in the front of the room still gonna have anxiety. It's 10% of your semester grade. Let's not add to it by showing them disrespect. Let's please be respectful with people presenting. It's just common courtesy. All right, so one other thing that's gonna just be very clear about that presentation, okay? It's gonna be a little bit different than your homework assignments, right? So what you're gonna do for the presentation on historical is I'm gonna give you two companies, just like we're practicing this week, right? And you're gonna analyze their ROIC tree and CFI over 5 years, both companies, right? And then, so for example, this week, analyze Lilly over 5 years, ROIC tree, CFI. Analyze Merck, ROIC, CFI over 5 years, and the changes, and talk about it. Then compare and contrast the two. Compare and contrast Lilly and Merck after you've analyzed them, and tell me who's doing better and why. Okay, in the ROIC and the CFI over time. So that's everything you got to do in 10 minutes. So it's going to be tight to cover all that, because you're not just doing one walkthrough, you're basically doing two walkthroughs in a comparison. And that's only 10 minutes. We have to enforce the time. So my other recommendation for the presentations next week, practice. Don't come in and riff. You'll run out of time and it will work against you. Because even if it's in that PowerPoint and you don't get to it, we can't give you credit for it. So you got to say it in the room or you're not going to get credit for it. So mind your time. And so if somebody goes way over on company one and they don't leave you enough time for company two, then you could end up with a 5 out of 10 on your group project. So practice. And the other thing is, if you need to use note cards, absolutely. You know, write a script, read your script. That's fine, right? What's important to me is you understand the concepts, so you convey the concepts. And if you need some prompts to help you remember that, that's okay. Okay. But nonetheless, you do have to decide who, is going to present. And remember, across all 4 presentations, eventually all of your team members have to present. So you can still have somebody present this one that presented the last one. Again, you got to get to all team members across all 4 presentations. This is number 2. There will be 2 more. One on valuation, one on multiples. Somebody just asked in the chat, when will the companies be posted for the homework and the project? Later today. After I record this video, I'll go grab the data because I still haven't decided who I'm giving you for either yet. And by the way, I'm going to change the format of your next homework assignment to be this format. So for Monday, your next homework assignment will be similar to the exam. Here's 2 companies, analyze them both, compare. Okay, CFI, ROIC tree. So a little more practice on that on Monday. And then Wednesday, you go live with your presentations. And again, companies coming later today. And to be honest with you, I'm seriously, like, I haven't figured it out yet. I'm going to kind of look through the headlines and see who might be interesting. And given what the brutal nature of what's going on in the market, there's a lot of interesting companies out there. All right. Any other questions? These are great questions. All right, so let's get back to the content. So on Monday, what we did is we went through the ROIC trees of Merck and Lilly for practice. And in that format, and compared each, analyze each, compared each. Today, we're gonna do the same thing with the CFIs, right? We're gonna go through the CFI Merck, we're gonna CFI Lilly, we're gonna compare the two. Okay, but before I turn you loose, because I'm gonna give you some time in some groups, random groups, just to kind of practice yourself, because you got to practice. Listening to us is not going to help you. You got to be able to do this yourself, and then we'll kind of debrief that at the end. But before we do, I'm going to go through one. So let me switch to different Excel. Share. All right, so here's Procter and Gamble. And let me put this over here. Make it a little bigger on my side. Here we go. So this is Procter and Gamble, going through 23. Don't have the 24 results yet, but this is the 5-year CFI, and 5 of the individual years total sum of the 5 years, right? So again, when you analyze a CFI, we always start with free cash flow, which is basically this number right here, okay? And you start out 5 years, 17.766.7 billion of free cash flow. How did they do it over 5 years? Well, they generated 33.6 billion of gross cash flow from the income statement. They reinvested 15.9 billion back into the balance sheet, working capital and CapEx. And that gave them an average 47% reinvestment rate over the 5 years, which again meant approximately a 53% theoretical payout rate. Okay. And that gave them about the 17.8 billion. They didn't really do any acquisitions over the last 5 years, so no change in goodwill. So that became their overall operating free cash flow. Okay. One other thing to note is that their CapEx to depreciation ratio averaged 209%, and last year was 195%. And we said that when that number is well over 100%, that suggests growth. All right, so P&G has been trying to grow consistently over time, over the 5 years, and in 2024, they were kind of signaling based on their CapEx to depreciation ratio that they were likely to expand again in 2024. Okay. In fact, you can see that here because they're spending $4 billion of capital and they only got $2 billion of depreciation. So that net extra 2 suggests that they're trying to build something, right? So again, just a short-term indicator of growth. Okay. Now, here's what's going to be different. We don't just worry about the totals. Now we're caring about the individual years, and we're looking for patterns, right? So pattern number 1, the NOPAT continued to grow every single year from 3.7 billion to 6 billion over that 5-year period of time. Okay. Pattern number 2, CapEx depreciation, generally around 200%, although they spent a little bit more in 2020, a little bit less in 2022. Okay. And when they spent more in 2020, they upped their CapEx to the highest level at 5.3 billion. And at the low point, it was 2.9 billion. Okay. And again, the investment rate, again, 40 to 60%, although a little bit lower reinvestment rate in 2023, but still signaling some growth overall for the firm. Okay. Given that they had $17.8 billion worth of free cash flow, how did they turn that into $11 billion worth of CFI? So we know that rounding off, 6.7 billion went somewhere. Where to go, right? Well, first thing that jumps out at me is we put almost $6 billion, 5.96 billion into excess cash, right? So they took some of that free cash flow and they put into savings. In fact, 2 big years. They put a bunch into savings in 2023, and they put a bunch into savings in 2020, 3.6 billion and 3.9 billion respectively. They also generated or spent cash, $1.6 billion of non-operating assets increasing, right? So they bought something, non-operating assets. Most of it occurred of that 1.6 billion in 2020 when they invested 1.336 billion. Okay. Now, they also had some after-tax interest income, which added to the CFI of about 819 million, and a couple FX gains and losses that are relatively trivial. But basically, they turned 17.8 billion of free cash flow into 11 billion of CFI, primarily by doing these two things. They put 6 billion in the bank, and they bought about 1.6 billion in non-operating assets. Now, assuming they had 11 billion to pay out to investors, what do they do with the debt and equity with the 11 billion? Okay, well, 605 million went to interest. Okay, makes sense. They increased their debt by negative 2.6 billion. And I already alerted you that this is likely a midterm question, that this was not necessary debt. I mean, if you got 11 billion of CFI and you got 17.8 billion of free cash flow, you don't need to borrow debt. You've already invested, and after paying for the investment out of your income, you still had essentially 18 billion of cash. And after putting some in the bank, you still had 11 billion to pay out. So they didn't need to borrow the debt. So they borrowed 2.7 billion. Almost all of it occurred in 2020. Why? Because they paid 11 billion in dividends, and they bought back, see here, $2 billion worth of stock, right? Well, 11 billion of dividends is the 11 billion of CFI. How do you buy back the stock if you spent all your CFI? And the answer is, that's where the debt is. That allowed them to buy back the stock. You start to clearly see that here, right? Now, as we look at this, we can see that they consistently repurchase shares over the 5 years, right? Matter of fact, they started increasing last year, share repurchase to 676 million. And dividends, again, generally went way up here in 2020, was it 2021, to 5.7 billion, middle of essentially COVID. And then they started actually peeling back on the dividends. So they didn't maintain that high level of dividend over time. And again, they didn't really have any acquisitions. Again, they had no change in goodwill, so there's nothing really to explain in M&A. But if they did, like, who did they buy? And you know, what names of companies? How much did they pay? All right. So and so a little context on some of these numbers. So as I said, when you do the intermediate years, you're looking for trends and you're looking for outliers, right? And that's what I want you to highlight. The only difference is next Wednesday, I expect you to explain those outliers. Today, we don't know enough. It's fine. We're just kind of working through the mechanics, but this is what we're working to. You got 8 people on your team, put them all to work. Research the company, right? Now, ideally, you'd have done a little bit of an EIC before you did the historical to get the context of what's going on. I'm not mandating that that's being done, but it couldn't hurt to understand the context of the numbers that you're explaining, right? This is not just an exercise in reading data. Anybody can do that. Anyhow, Procter and Gamble. Questions? Great. Time for practice. So in a folder on Elms called March 5th, under the files folder are 2 files. Where's it? March 5th down here. In this folder, there's a file called Lilly CFI, and there's a file called Merck CFI, continuation of the companies we were working on Monday. So I'm going to put you into teams, and your task is to accomplish 3 things. Number 1, do a 5-year walkthrough of Lilly CFI. Number 2, do a 5-year walkthrough of Merck CFI, including the kind of key points in the interim. Number 3, compare the 2. Over the 5 years, based on the data, who would you think is doing a little bit better based on that CFI data? Okay, those are the 3 questions I want you to address in teams. When you come back from the breakout rooms, I'm going to call on your teams to answer those questions. So practice now. When we get back, we're going to go through this. I'm going to give you 20 minutes to work on this in breakouts, and then we're going to come back and we're going to debrief this. So make sure you have some spokespersons ready in your teams when I call on you to go through the exercise. So again, Lilly, Merck, each company, 5-year CFI, 5-year CFI, the 2. Questions about what I'm asking you to do? Because this is the structure for your next homework assignment and the structure for your next group project presentation. So we're going to practice in class today. All right, hold on let me put you guys into some breakouts here. What do we got here? I'll put you into 3 teams, so that way. And I'm going to put a countdown timer so you can see it for 20 minutes. And I'll see everybody on the other side. Good luck.
And then something that we noticed in the lab is that the Merck and the Lilly CFIs are the same numbers.
Oh, are they?
Yes.
Let me see what I did wrong. Hold on. All right, welcome back. So why don't we start with the first team, which was Fabiana, Jay, Kayla, Aiden. And why don't you guys go through Lily CFI. So someone in your team, share your screen and start walking through.
So I'm on my phone, so I can't share my screen because my computer doesn't allow audio.
Okay, if somebody else can share and you can talk, or however your team wants to do it.
I can share and he can talk if he's up to.
Okay, that'd be great.
Okay. You said Lily first, right?
Yeah, you guys are doing Lily.
And
And
me.
just, you know, team 2, Carter, Jack, Kevin, Luke, Tony, you're gonna be doing Merck next.
So starting off with Lily, their NOPAT between 2020 and 2023, this hasn't really changed a lot. Their total is 33 billion, which compared to Merck is significantly lower.
You're not
2020.
doing a comparison. Right now, you're just
Okay,
doing Lily.
all right. Sorry about that. And then for CapEx to depreciation, 2020, 161%, but the total is 220%. So this is showing us that they have a lot of growth expansion that they're planning on doing. Gross cash flows have been increasing with a 41 billion total. Gross investment 2.49 billion in 2020 to a 2024 gross investment of 9.9 billion with a total of 22 billion. So this is increasing as well. And then also with their investment rate over the 5 years, we can see that this is growing significantly, indicating that they are really pumping in a lot to their operations and their expansion. Going to the to debt over this 2020 to 2025, their debt is increasing significantly. This
Well, if I can stop you,
yeah.
you skipped over the whole non-operating section. So
Oh,
you
sorry
should
about
do,
yeah.
yeah, you do operating, non-operating, then debt equity. Just, I think it's easier to follow the flow. 2 other just constructive things. You didn't start with free cash flow, you started with NOPAT, gross cash flow, which is kind of a little bit okay, but the whole idea is they generated almost 17 billion of free cash flow. Why? And the trends are still there, meaning you started to point them out, but like in 2020, you know, they had 5 billion NOPAT, 2024 doubled. CapEx 2 to 6 doubled over the 5 years. Growth, so basically gross investment went from 2.5 to 10. So it's increasing each of the years. I think that's the other important trend to highlight, because a lot more of that investment occurred in 22, 23, and 24. So it suggests, as you were saying, that they're ramping up. And back to context, what's going on with Lilly that would cause them to spend all this money on ramping up? Does anybody know?
Are they, is it because they are repurchasing a stock?
It's no, we're still in the operating section. Like, what do they spend all the why are they spending all this CapEx? Right? What's going on? Yeah, Carter.
Aren't they ramping up for their GLP-1 production?
Yeah, exactly. This is Manjaro. And so basically it launched a couple years ago, and that's why they're spending heavily, because if you guys paid any attention to the news, there's been a shortage of GLP-1s, both Novo Nordisk and Lilly, for the last couple of years, that they just are now catching up to meet demand. And so this is the scaling back up to meet that demand. So that's what I mean by context. There's a couple trends here, and just, why the trend? Like, why are they spending so much more? And there's an answer for it. And so that's something you guys would have figured out. But let me let you go back to the original. So you're at the 16 billion free cash flow. Start talking about the non-operating cash flow.
All right, yeah, so next we're gonna be talking about the non-operating gains. The non-operating gains haven't really, they have actually declined from 2020 to 2024.
From what to what? You need to use
From
the numbers.
Yeah, so from 2020 it was 1.28 billion, and then 2024 364 million.
Well, think of it this way. What was the biggest reason that the free cash flow went from 16.8 to the CFI that went to 7? Where'd almost all the money go?
To CapEx.
Between free
Capital
cash flow and
expenditure.
CFI, what happened in the non-operating section that they chewed up almost, I don't know, 9 billion of cash? Like, what was the big item that was driving that down?
They bought some non-operating asset.
Yeah, the 11.6 billion in non-operating assets, but they pretty much increased every year. So I mean, it's also important to kind of get the big things, like what's causing the free cash flow to become the CFI. Well, it's kind of like you got two balance sheets. The income statement explains the difference. You got a point in time with the free cash flow. You got a point with the CFI. What happened in the non-operating that got you between the two? And hitting the highlights there. And the big one you just pointed out is the 11 billion of non-operating asset purchases, which was pretty consistent every year for 5 years. By the way, before we go to the last section, has Lilly done any acquisitions? We know Procter and Gamble didn't. Did Lilly do any acquisitions? Looking at the CFI, did Lilly do any acquisitions? And what number would tell you the answer to that question?
Would it be
Goodwill.
Yeah, the investments in intangible and goodwill. The row right above the free cash flow. That tells you that in 4 of the 5 years, they bought people. In fact, their largest acquisition they bought was in 2020, where they spent 919 million of premium. That's premium. That's not purchase price. And another 600 million in 2023. So back to next week, who'd they buy? We should have names in that presentation. All right, you got 7 billion in CFI. Talk to me about the debt and the equity.
Yeah, so moving on to the debt and equity. So in 2020 they had 1.27 increase in debt, and then moving on to 2024, you can see this substantially move to 9.56 billion. So this is telling us that they're increasing their debt significantly. This could go and then we can also see with common dividends as well. This is from 2020 going from 2.68 billion to 4.68 billion.
Okay. They buy back a lot of stock.
Yeah.
How much?
2.3 billion.
No, it's the number above 6.5 billion.
Oh, sorry.
But yeah, they bought 6.5 billion of common stock. They paid 18 in dividends. That's 24. How did they pay 24? A lot of that was the debt. That's where the 19 billion came in. But there's an additional point with Lilly. I think if you look, when did they issue most of the debt?
2023. No, 2024, sorry.
23 and
Both
24.
years.
Yeah, big 9 billion or so, rounding off 9-10 billion each.
Mhm.
So there's the other thing. What did they spend a lot more money on in 23 and 24? Look towards the top.
The capital expenditures.
Yeah.
And
So I think in Lilly's case, it was a combination. They used the debt to fund the capital expenditures and to buy back the stock. Whereas when we looked at, for example, Procter and Gamble, they were just buying back stock. They didn't need to fund additional CapEx because they weren't growing as much. Lilly growing gangbusters, they're borrowing money for that growth, at least at that point in time. And you can kind of see that story emerge from these numbers. Does that make sense?
mhm.
All right. Well, thank you for being brave enough to go first.
Yep.
Again, I'm trying to give the criticism now because I want to see you guys succeed really well in your presentations next week.
Mhm.
All right. Room 2, you're up.
Appreciate it.
Merck,
Thank you.
Carter, Jack, Kevin, Luke,
Mm.
Tony. You guys
All
have
right,
Merck.
on my screen.
We can see it.
Oh, okay. So starting with NOPAT, they totaled around 50 billion, which increased significantly from 2020. They had a little below 4 billion, and then in 2024 they had 17 billion. And then looking at their capex to depreciation ratio, it's around 150%, meaning it's outpacing depreciation, which means it's like pretty forward-looking as they're investing in their own business. The gross cash flow was 70 billion in total, with 2024 being an outlier as they generated 21 billion in gross cash flow. And then, yeah, their investment rate is 44% over the 5 years, with it actually decreasing over the 5-year period. It started at 90% in 2020 and then ended off at 18% in 2024, with the exception of 2023, as that was like considerably higher at 141%. And then their investment in goodwill and intangibles is negative across all years besides 2021, which was 11 billion, and that was a cash outflow. So they must have acquired a company in 2021, whereas in 2022 to 2024, they actually had positive cash inflows from goodwill and intangibles. And my guess would be that they divested parts of an previous acquisition. And that left them with free cash flow of 33 billion in total. Most of that coming from 2024 because they had 19 billion. And 2022 they had 17 billion, with the rest of the years being either negligible or negative at 4 billion in 2021. And then, yeah, from free cash flow to CFI, we can see that they invested significantly in net non-operating assets, which was a negative 11 billion. And they had negative almost 6 billion in 2020, along with 2024, with a positive 3 billion in 2021, which left cash flow available to investors at 26 billion. And then they took on 10 billion, almost 11 billion in debt in total, most of that coming from 2020, which was 6 billion, and then 2023 at 4 billion. And in total, it looks like after tax interest expense was 3 billion. So it looks like they had 33 billion to kind of distribute to shareholders, which they did 35 billion in common dividends, and share repurchases of almost 5 billion. And yeah, that's basically it. And it looks like, I guess I would just add that their capital structure is leaning towards equity just because they distributed like the scale of almost 10 times as much to equity holders as opposed to only distributing 3.5 billion in interest expense. Oh, it looks like you're muted.
I said, that was a good job. The only thing I saw as a trend that jumped out at me a little bit was the 23 to 24. Like they were ramping up sooner than essentially Lilly with their CapEx, and then it kind of dropped off in 24. The reinvestment rate fell to 18%. You know, the CapEx went down a little, 5.1 billion, even though they're making more money and growing. So essentially, you know, back to context, if you dig some digging, what you're going to find out is they have, as I think I mentioned in class now, the best-selling drug in the world called Keytruda, a big expensive cancer treatment. It just got bigger, faster, earlier than the Lilly drug. And I think now that they've kind of ramped up, they're slowing down the ramp up. Whereas Lilly is still more early stages of the ramp up. And that you can see in the 23 to 24 drop off, but just little context for why it slowed down a little bit for them. But overall, good job. So thank you. We picked up some tips and trips for the first team. So final team, which is Amber, Ashley, Brian, Dylan, and Osmian. If you can talk about the comparisons. Looking at the two companies, you just heard it from the other two teams as well. Like, who do you think is doing better and why, based on that data?
Well, I'll take it. So for our group, can you see my screen?
Yeah, we can say it.
I believe I have Lilly and Merck right here.
Yep.
So starting with Lilly, we can see that they are expanding more aggressively than Merck. As you can see here, the reinvestment rate for Lilly here went up to 99% in 2023. I'm sorry, I want to talk about the capex over depreciation, which is a lot higher, which shows that they're expanding and investing a lot. From 161% in 2020 to 337% in 2024. That almost doubled. Which shows that they are probably in an expansion part of their life cycle, where Merck is more in a maturity stage of their life, as we can see here. The capex over depreciation actually went down over the course of the last 4 years, 175% in 2020 to 144% in 2023. Now, something that we wanted to point out here with Merck is that for the investment rate, every time the investment rate went down, their free cash flow also went down. I'm sorry, every time the free cash flow went up, sorry. Except from 2020 to 2021. Here you went from 90% to 51%. Free cash flow went down, but they also invested a lot in goodwill. For 22 and 23, we can see here that, I'm sorry, for 23 to 24, we can see that the investment rate goes down from 141% to 18%. And that increase of free cash flow, that was also pushed by their NOPLAT. So somewhere else where we could do a little comparison is their debt, income, and dividends, if you go all the way down here. So as we can see, Merck has a lot more, is paying a lot more dividend. We can see here in 2020, 6.2 billion and 7.8 billion in 2024, compared to 2.6 billion in 2020 and 4.6 in 2024. So all of this is to show that the two companies are maybe in a different part of their life cycle, while Lilly is expanding more aggressively. We think as for now, Merck is in a better place just in terms of cash flow, or free cash flow, 33.5 billion total, compared to 16.8 billion for Lilly. So for now, they're in a better place, but we think that that is because Lilly expanding more. They are reinvesting more and buying more company, as we can see with their goodwill. So to sum it up, we think that Merck is in a better place right now, but in the long term, Lilly could be expanding a lot and see the result, the benefits of the expansion and go past Merck.
Yeah, good job. And again, what I liked is that you showed the context. Like you took all the numbers and you kind of told a little bit of a story that seemed to be coming out of that. And I think that's another helpful part of this. And then you made a point of view call that, yeah, right now, Merck, longer term, probably the trend says Lilly, but right now Merck. And here's why. So that's exactly what I'm looking for when you guys are doing this. So good job, teams. I'm going to share my screen real quick. So if you can place.
I'm trying. I'm on it. Oh, there you go.
There you go. But just to give you a sense of something, like if you go to Merck's EEO, what he just said, oh, I can't type today, EEO. What he just said shows up in the numbers. Like if you look at Merck, and this is their next 4 years, like they're growing, but 64 to 74 billion, they're kind of plugging along with some decent growth rates. If I were to switch this over to Lilly, over the next 4 years, they're going from 45 to 90 billion. So they're expected to double in size by 2028. And so you're already starting to see that start to show up in those 5-year analysis that you just did. Because all that CapEx at Lilly is to support that growth. And over here, specifically, it's for Mounjaro and Zepbound, going from about 15 billion a year to 50 billion. So this is what all that CapEx is for, right? Now, again, just context on what you said, but the themes that you guys brought out, like you're kind of talking about the real themes of the company, and that's the links that eventually I want you guys to make. So good job overall. Final questions for today before we wrap up. All right, so a little bit later today, I will post 2 things. I'll post the next homework assignment to Monday, which will be in this format, and I'll give you the companies that you'll need to do for next Wednesday for your group project presentations. So you guys should be able to get working on that pretty quickly. I know your TAs, I think, Ashley, you still in the room?
Yep, I'm here.
Again, take advantage of her team, and if you need help, office hours, they're still having them. If you're struggling with any of this, whether it's analysis, interpretation, whatever, that they're great. They can help you. They're on campus. So please do take advantage of that. All right. Last thing, what does it mean? Question. When a company has negative goodwill. So it's basically, it goes back to accounting. When you buy somebody, the difference in the purchase price and the actual assets that you bought, you explain that with what's called goodwill. That's the plug, right? And technically, you don't amortize goodwill anymore. It can stay there forever. So 2 ways goodwill goes down. Number 1, you impair it. You basically say it's not worth it anymore, and you write it down. Or number 2, you sell something off. And so one of the things that was mentioned is they could have sold something off, or it could have been impaired. One of the 2. But that's generally what goes down when you see negative goodwill. But anytime you see goodwill go up, cash is going out the door. That's just an important tip and trick to remember from accounting. Brian?
Yeah, I have a question about share repurchase and issue. So here, my understanding is when we issue share, money comes in, but the number here is negative on, like if I'm looking at Merck, for example. And same for repurchase, like money comes out, but I see as a positive number here. Just want to make sure we're
Well, it's odd, but companies will actually both repurchase and issue shares simultaneously. A lot of times for issues, unless you're like, Boeing, you need cash and you just do a share, raise a bunch of cash. One of the things a lot of companies will do is they will give stock options. And to inoculate the shareholders from being diluted, they will buy back a certain amount of stock to offset the options, right? And then when people cash in the options, then they might issue the stock to basically fund the options that are being issued. So you could see a little bit of both that could happen potentially in 1 year, but usually if you're buying back, you're not issuing the same amount. You typically buy back more than you issue. But you'll see particularly tech companies, pharmaceutical companies, with high flying stock prices where a lot of employee incentives are driven by stock. You'll see some stock issues as well outside of just pure financing reasons.
Okay, thank you.
Well, we're at the end of our time. Thank you guys for attending today. We'll have another practice class on Monday. And otherwise, look for the assignment to be posted a little bit later today. Have a great day.
Thank you.
Bye-bye.